Well, the love affair between U.S. stocks and the Federal Reserve is coming to an end, according to our next guest. Doug Cliggott says the rally is going to slow and stop when QE2 does. Doug's the U.S. equity strategist for Credit Suisse, and he sees the S&P pulling back about 10% this summer. So, Doug, for the year, S&P's up about 6%. Is this as good as it gets?
I think for now, Margaret, it probably is. And you know, I think we have to start the discussion with a lot of humility. We don't have a lot of experience with what happens when the Federal Reserve stops buying assets. We really just have one example. But in that one example, the S&P did pull back by about 10%. And so we think that's a pretty good base case to really approach this summer with.
Now, the example you're referring to is what the end of the mortgage-backed securities purchase.
That's right. In effect, their first large-scale asset purchase program that ran from roughly the beginning of 2009 through the end of March 2010.
Right. And I raise that question a lot to strategists who come on, and to say, you know, why is that different from what you're seeing happen at the end of June? And quite often you're told, oh, well, it's because at that time we'd also seen some economic data points that were worrisome. We had seen corporations continue with cuts, not really invest cash. Fundamentally, what's different here at this point?
Well, there's some things that are different and more positive. Unfortunately, there's some things that are different and less positive. I think the different and more positive is we are growing jobs now. We're absolutely growing jobs at a more rapid pace than we were a year ago. But if you look at some of the leading indicators of growth, we are seeing weekly jobless claims going up. We're seeing consumer confidence coming down. We're seeing the ISM for manufacturing, a good leading indicator, that's softening. But I think maybe the most meaningful trend that is less positive now than a year ago is what we're seeing on the inflation front.
Yeah.
You know, we'll get CPI tomorrow. Most people.
Wait, so Doug, you call it inflation? Because the Fed doesn't.
Well, I think, you know, people have different perspectives on what we want to measure and what we don't. I think food prices matter. Energy prices matter. We got data at the beginning of the week on import prices. Non-oil import prices are up 4.3% versus a year ago. So the weaker dollar is leading to more inflation. So it's a different environment from where we were last summer. Some of it's better. I would argue some of it is actually a little more challenging than a year ago.
Well, Doug, in reading your report here, I love seeing this statistic here because you quantify it. You say $600 billion in purchases by the Fed is equal to what would be 3.2 years of average mutual fund purchases in just 8 months' time.
Right. And, you know, in some sense, Margaret, when we're dealing with something where we don't have a lot of historical experience, again, you know, we've seen this happen just once before, our approach is trying to put the numbers in context and applying common sense. And in our view, when they put that huge amount of money into the marketplace in such a brief window, of course it has a positive impact on asset prices. But the flip side of that is I think it's only reasonable to expect that asset prices come down somewhat when they stop those purchases.
Is that what's behind this drop-off in commodity prices? And I know you don't think that the Fed's going to step back in here with more help if we do see the declines continue.
Well, I do think that's part of it. You know, commodity prices are pretty complicated. There's a lot more complicated than equities, I think. You've got, you know, demand considerations in the developing world. And there you're starting to see a lot of monetary tightening, which is causing concern about future demand for commodities. Because of a zero interest rate policy, you've seen a lot of investors investing in commodities rather than traditional asset classes. That's a piece of the puzzle, and I think anticipation of what happens next is also a big part of the puzzle. So I think it's absolutely connected.
Doug, there are a lot of people hoping that you're wrong, but we will see what happens at the end of June. Always good talking to you.
Likewise, Margaret. Thank you.
Thank you.